What is up, mortgage world, and happy President's Day. Thank you for joining us anyway for this Monday mortgage market meeting with myself, Sean Grapevine, manager of Agent Direct. And today, as with every Monday, for like the last 9 months, I mean, talk about consistency. I am joined by the Sultan of SLAs, the king of collateralized debt. He's the Colossus of credit, the Titan of the 10-year, the great Bambino. Do you know what I mean? Oh, it's the one and only Austin Koenig. Welcome, Austin.
Sean, I love the enthusiasm. That was great.
Thanks, man.
Appreciate you doing a little something different every single time.
You're welcome. Did you get a haircut? Did you shave something?
I did get a haircut last week. You're right. Did not shave this morning, so we're kind of rolling in with a little bit of a 5 o'clock shadow for sure. But hey, we'll take it.
Nice. Looks great. Well, welcome, and thanks, like I said, for being here. Let's do a little weekend review. How did last week treat us? Where are we at? What are rates doing? And why?
Yeah, so I think last week was a continued reprice of the strong data we've seen come through. What we're looking at is inflation data not looking as cool as we wanted it to. We've also seen the jobs numbers look hot at the end of the day, and these are the things that the market has been repricing in real time. Actually, this is a great thing to kind of think about is the Fed meets every once in a while, right? Like, we're going to have another meeting in here in March. I actually don't know the date right off the top of my head, so sorry about that. But they meet, every once in a while. But the thing is the market gets provided data that the Fed has kind of told them, hey, this is the data that we're looking at. And at the end of the day, they've been repricing all this past week. And in fact, like where we started this month, a lot of people were thinking Fed funds rates peak in summer, sometime in June possibly, and maybe it's between 4.75 and 5. That's kind of what we were talking about, to start the year. That was the mantra, and pretty much everyone was agreeing upon that. That has changed, and what we're seeing now is the market kind of pricing for 5.25 peak rate or even higher possibly. Some people are always going to be varying from where the market is, but 5.25 is kind of where we're landing at. And, that's a whole nother Fed rate hike that the market's anticipating. And, who knows, if data continues to be hot, how relentless is the Fed in terms of their approach. And I think that's kind of why the Fed minutes are going to be more emphasized than usual, because
when do those come out?
Those come out on Wednesday. So actually, I don't know exactly what time. I think it's usually around the afternoon when those come out. But when the market gets to really dig in and digest that, I think there will be hopefully a little bit more clarity of, how the market can see exactly what the Fed's thinking, that's documented. We also have, Federal Reserve members come out and speak, here and there during some weeks. And the last week, there wasn't any taming of the market that the Fed did by any means. So I think really, this is what we're living with, and it's a reprice. And obviously we've seen, rates really creep up, and, kind of the low sixes of, the average mortgage rate is now kind of gone away. And we're, approaching at the higher sixes, as we continue on throughout February.
Yeah. It's definitely unfortunate that the rates keep creeping up, but I think really the average home consumer isn't worried so much about what rates are today. It's more like they really want to compare them against like the recent past. And so that's why I think, we ran into so much just sticker shock back in September, October, November, where rates are, we're just a little higher than they are right now. And people were just like, I just can't do it. But now, Americans are really good at adjusting to that new normal. And it seems like, wages are on the rise as well. Home prices aren't so crazy exorbitantly, they're not repriced 100 times to the moon. And it seems like people are really getting used to the, seeing a 6 in front of the rate and just being like, well, I gotta buy a house. So, it looks in our lock, right? Our lock numbers, as I'm sure you know, I mean, you sat there every day watching these locks pour in, right? Like our lock numbers every week for the last 4 weeks have hit record numbers, despite rates going up every week for the last 4 weeks, right?
No question. It's a testament to everyone here doing a great job. I think what's great about this is, we've really had some great lock numbers. We've already broke through our funding record, really already at this point in the month. So it's pretty encouraging. I mean, it was a great January for us.
Love it. Great work.
Oh, no question. And this February is also going to be pretty good. I know today's not going to be probably a banner lock day because the market's closed, but hey, it's one of those things where it's really encouraging to see how well everyone's dealing with the circumstances of the market. And I think generally you're right though. It's people are still interested in buying houses, and it might not be the craziness of 2021 by any means, but there are still home buyers out there. There's still home sellers out there. There's still people who need to use their home for some sort of instrument of providing cash to themselves, like refinances and HELOCs and all that good stuff. So that's still something that's going to be out there, and there's business to be had.
Yeah, for sure. And so we have two pieces of information, two big pieces of information. We got those Fed minutes, like you mentioned, on Wednesday, and then is it Thursday or Friday when we ingest the PCP?
So yeah, the PCE, yes. We
okay. Sorry.
That on Friday. Hopefully we don't have any negative
reactions to ingesting it.
Yeah. Hopefully it's good. It's a good batch of PCE, and we'll have that hopefully bring some rates down. But I mean, if it's anything like CPI, it'll probably be similar reaction. We're just hoping for nothing worse than what CPI brought us. And CPI, I think what we wanted to really gather from that is, sure, it looked like it came down month over month, but it didn't come down at the speed everyone was kind of talking about at the end of last year, of like only 0.1% up or 0.2% up. It was like 0.4%, and that's a little too fat, like still too hot. Even though it's a lot different than what we're seeing in the peak of inflation, it's still a little too hot. So when the Fed sees any sort of embers still burning, they want to pour water, right? So.
Yeah, well, and it's an excellent opportunity for people to get into a home without engaging in price wars. And I mean, the more people that we get into homes now at reasonable prices, also the more people we get to help get into reasonable rates later in their home buying life, presumably. I mean, at some point rates will probably be lower than they are today. I mean, I can't say that with any certainty, but there have the ebbs and flows of business provide opportunities for refinancing. So if we're getting people into homes they can afford today, then a year, 2, 3 years from now, we're going to be able to keep them in those homes and make them even more affordable, which is great for them. It's great for us, and it's a everybody win situation. So I don't mind having this book of business of where the buyers get to be picky, and then I'm also given a large a group of people that I can help later on get an even more, an even better deal. So, the last thing you want is just wild swings in the market. So, that 6.25 to 6.75, like if that's here to stay, all the better. Like going down too fast, horrible, right? And going up too fast, horrible as well. So it's nice to see a little bit of stabilization here.
No question. I think that really provides you as the loan officer the ability to really provide yourself as the financial advisor, for the future for them when it comes to their house, right? You providing that information, that knowledge, they will call you back, at the end of the day when they're kind of ready to make that next move, where they kind of see, or you provide them that information or update of like, hey, this is where things are going a year or two down the road. You provide that up front. I think it just, bodes well for you in the future, of course, pays dividends.
100%. Well, yeah, it's kind of going to be a slow day today in the market. Hopefully we can make Austin eat his words and make it a busy day for the lock desk.
Please do.
Yeah, some big pieces of information coming out to either support what we've already seen, or like maybe we'll get some good news, a new perspective from the Fed or a complete rejection of what we expect. So definitely keep your eyes open on Wednesday for that. PCE, huge, just as important as CPI. It seems like to the Fed anyway. So keep an eye on that on Friday. And remember, if you like it, lock it. Anything else, Austin? Any news from the lock desk? Any requests? Any new initiatives? Anything we should know about?
No, but we should be. I think by the end of today, we'll be posting a LLPA update, kind of culminating all of the investors that we deal with, really for a bulk of our agency business, just kind of making sure everyone's aware of kind of the parameters that these new LLPAs are going to be rolled out. Everyone's going to be rolling out a little bit differently. And unless you're doing kind of a longer term lock, it's probably not affecting your 30-day locks from the bulk of your business right now. But, everyone's kind of got their own little special things. So I really encourage everyone to review it. We're trying to, cut all the fat out and make it as easy to read as possible. But it will be something you kind of want to consider, looking through at that point, as well as I'll be sending kind of a daily, news update blast, kind of on an almost daily basis. I'd say can't guarantee it's going to be sent out every day, but I did send one out Thursday of last week. I'm going to be sending one out later today as well. So just keep an eye out for that, and hopefully that's helpful, for your daily consumption as well. So that's pretty much the only announcements, real quick, from the lock desk side of things.
What about this? Anybody who's made it to the end of the mortgage market update, maybe we can get some a weekly little tease in here for them. Any teasers for new lenders or new products that we should expect? If you can't tell us which lenders or which products, can you tell us if we have some fun ones in the pipe?
Yeah, so here's a couple fun ones in the pipe. Really, the next two non-QM lenders that will be rolling out at company level are LendSure and FNBA. So FNBA's a big I-10 lender. They actually do it like on their portfolio. So they usually offer better LTV, like 85% LTV than, your typical, non-QM lender that, I-10 loans don't do well in the secondary market. So that's, a good addition to have. Additionally, LendSure just has a, bulk of, non-QM products, as well as some, fix and flip things as well. So, that kind of really provides a product need for us. Union Home is going to be the kind of next big lender, like where we're actually doing non-del, conventional, govy, and all the good stuff. All that business with Union Home should be rolling out here once they're actually live and arrive. So we're already approved with them. We're not going to send any loans to them until we're squared away with their pricing showing up and arrive. Non-del is just very difficult to roll out when it's not built into arrive. So those are some things that keep a lookout for. That we'll be making announcements as has been rolled out. But generally, that's kind of the big things that we'll be announcing here in the near future, and there's more to come from that as well.
Fine. Okay, I'll try to remember to keep asking every week so we can get some little nuggets in advance. So, all right, guys. Well, I'll leave everybody to it, and appreciate you hopping on as always, Austin. And thanks so much for your time, everybody. Happy President's Day. Go lock some loans.
See you guys. Thank you.